fundsupermart.com.
In this episode, Aberdeen's Daly describes how emerging market debt will continue to outshine in 2012. Hello, Kelvin. To start with, what's your general view for the emerging market debts in 2012?
We have a constructive outlook for emerging market debt. I mean, obviously this year we've seen a big pickup in risk appetite. That's not to say that we could see some periods of weakness throughout the course of the year, but I think, when you look at what we went through last year, a very challenging period, we think that the global backdrop it has improved from last year, so less concerns about a big blow up in Europe. U.S. growth is surprising on the upside. EM growth will remain still pretty strong, so growth of around 5.5% this year. And really, China remains the key driver for us. We think expectation for growth in China this year probably to come in the range of around 8%. I mean, the consensus is slightly higher than that. We think there are some downside risks to that growth scenario, but we don't envisage the dreaded hard landing in China. So we think that again the outlook for emerging market debt is still positive.
Which countries or sectors are you more in favor of?
In our portfolios, we have overweights in Latin America. So that would be, if you look at our model, blended portfolio, we're overweight Latin America. You look at our local currency portfolio, overweight Latin America. And then even our emerging market corporate bond portfolio, we're overweight Latin America. So that should reflect the fact that we generally think it's an improving credit quality. Latin American sovereigns have, for the most part, been upgraded to investment grade in recent years. You've seen a lot of EM corporates out of Latin America have performed very strongly, so there's some good opportunities in EM corporates in Latin America. On local currency markets, Latin American currencies have been volatile in the latter half of last year, but we've seen a pretty healthy rebound in some of these currencies too. So, generally speaking, overweight Latin America, underweight Asia, mainly down to the fact that valuations we think are pretty expensive in Asia. And in emerging Europe, Middle East, Africa, we're underweight in our portfolios as well in that region.
Will emerging market economies continue to loosen their monetary policies this year?
It's mixed. When I say mixed, we could expect to see more rate cuts in Brazil. We think China will continue to ease monetary policy as well, mainly through the reserve requirement ratio. Indonesia, rate cuts are done for now. If anything, the risk is now that they might have to hike later this year because there's expectation that they'll remove the fuel subsidies, which means inflation will start to accelerate. In other parts of the world, again, Mexico Central Bank will remain on hold this year. Same with South Africa. Russia, expectation probably for some rate cuts there. But for the most part, we think there's limited risk of rate hikes this year in emerging markets, whereas last year was concerns about inflation, and we did see a number of rate hikes in emerging countries last year.
And how will the rising oil prices impact emerging markets inflation?
Arguably, it actually has a bigger impact on developed countries, right? Because of the high oil imports in developed markets. So it is a tax on growth. Now, for emerging countries, it's mixed. Obviously, there's a lot of oil exporters which will benefit from improving terms of trade. But the countries which are most acute to rising oil prices would be the likes of Korea, Turkey. These are countries, again, India, which are big oil importers. So it will certainly have an impact on headline inflation, but we think emerging market countries are much more sensitive to rising food prices, which is a factor last year. So really, food is something for us that we're more concerned about. But right now, in over the medium term, but we think in the short term, food prices will not be rising at the same rate that we've seen in oil prices, because most of that rise in oil prices is down to geopolitical concerns.
In your view, is it an optimal time to invest in emerging market debt now?
Yeah, we think investors should be allocating more of their portfolios to emerging market debt. When you look at all the credit growth concerns, fiscal deficit concerns in the developed world, and on top of that, you have a lot more political risk in developed markets these days than you ever have. We feel investors are not getting compensated to hold those risks in their portfolios. In contrast, we think emerging markets are offering much more attractive yields. So in our portfolios, we're generating yields of anywhere between 6.5% to 7.5%. So we think that's a much more attractive risk-reward scenario for investors to allocate more of their fixed income portfolio to emerging market debt.